Today, we're analyzing United Power, a critical player in the powertrain sector for new energy vehicles. The company is currently navigating a classic conflict: intense, short-term pressure on its profitability versus a very ambitious long-term growth strategy. So let's dissect the data and see what's really going on. And this really is the central paradox that the market is grappling with. You have year-to-date revenue growth of over 35%, a very strong top-line number. And yet, when you zoom into the third quarter, the company's net profit actually declined. How exactly does a business grow its sales that quickly but see its profits fall? That is the core question we will address today. Our analysis is structured into 5 parts. We'll begin with the key theses up front. Then, we'll examine the short-term profitability challenges. After that, we'll assess the company's core technology and market position, followed by a deep dive into its financials. And finally, we'll look at the global strategy as a potential future growth engine. So, let's begin with the primary thesis. The narrative for United Power right now is defined by a significant divergence. On one hand, you have robust operational execution and strong top-line growth. But on the other, that strength is being overshadowed by considerable pressure on the company's profitability. So, to unpack this, our analysis will center on 4 key areas. First, we're going to examine that Q3 phenomenon of revenue growth without profit growth. Second, we'll assess the company's fundamental strengths in technology and market positioning. Third, we will use a DuPont analysis to deconstruct the drivers of its financial performance. And finally, we'll outline the strategic shift toward globalization as a potential catalyst for future growth. Let's start with the immediate issue, the short-term pain. We need to deconstruct exactly what is putting so much pressure on United Power's bottom line. And this chart illustrates the issue perfectly. In the third quarter, revenue grew by more than 15%. At the same time, however, net profit fell by over 15%. This stark divergence is precisely what has captured the market's attention. Our analysis indicates 2 primary factors are driving this. First, there's significant downstream pressure. The price war in the automotive sector is intense, and that pressure is being passed down the supply chain, squeezing margins for suppliers like United Power. Second, this is compounded by a deliberate strategic choice, a significant increase in R&D spending, which is an investment aimed at securing a long-term technological advantage. Now, that investment in technology serves as a natural transition to our next section, the cornerstones of the business. Here, we shift our focus from the immediate challenges to the company's durable competitive advantages, which form the bedrock of its long-term strategy. If you look at the revenue breakdown for 2024, you see an extremely focused business model. E-powertrain systems, that's the integrated motor, controller, and reducer, are the absolute core, making up over 87% of revenue. Power systems, which includes things like onboard chargers, accounts for almost all of the rest. This demonstrates a deep specialization in the very heart of an electric vehicle. And this is where that R&D spending becomes critical. A key area of focus is on silicon carbide, or SiC, technology. Essentially, SiC power modules are far more efficient at converting electricity, which reduces energy loss. For an EV, this translates directly into longer range and better performance, a crucial differentiator for automakers moving to 800-volt architectures. This technological focus has translated directly into market leadership. Among third-party suppliers, United Power holds the #1 position in motor controllers with a 10.7% share in 2024. Now, this places them in a very interesting position. While a global giant like Bosch leverages its established supply chain and a competitor like Huawei focuses on software for the high-end market, United Power's advantage lies in its comprehensive platform-based solutions that serve a very wide spectrum of clients. All right, let's move to the quantitative analysis. In this section, we'll perform a financial deep dive to understand the evolution of the company's performance and the quality of its growth. We mentioned the strategic investment earlier. This number quantifies it. Through the first 9 months of 2025, R&D expenses surged by nearly 50% year over year to just under 9.6 billion RMB. This is a very substantial expenditure and a primary driver of the short-term profit compression, but it also signals a clear commitment to maintaining that technological leadership. Now, this DuPont analysis allows us to deconstruct the return on equity into its 3 core components. And looking at the data, a clear narrative emerges. From 2022 through 2024, you see broad-based improvement. Net profit margin expanded, asset turnover improved, and financial leverage also increased, which all contributed to a very strong ROE of over 21% in 2024.
However, in 2025, you can see the pressure points. The profit margin has ticked down, and just as importantly, the equity multiplier has decreased. This is a direct result of the company's recent IPO, which strengthened the balance sheet but also reduced financial leverage.
So, having analyzed the current financial picture, let's turn our attention to the future. We'll now look at what could be the next major engine of growth, the company's strategic shift from domestic dominance to international expansion. This global strategy is being executed through several key initiatives. The new plant in Hungary is clearly a bridgehead into the European market, designed to serve clients locally and also to mitigate potential trade risks. The plant in Thailand serves a similar purpose, acting as a strategic base for the growing Southeast Asian market. Supporting all of this is a new sales office in Germany, which is crucial for building deeper relationships with major global automakers. And this slide puts the scale of that opportunity into perspective. As of 2024, over 95% of the company's revenue was generated domestically. The international segment accounted for less than 5%. So while it's a small portion today, it represents a significant and largely untapped source of future growth and revenue diversification. Which brings us to the final question. United Power has a clear technological advantage and an expanding global footprint. The company is making a very clear trade-off, sacrificing short-term profitability for long-term technological leadership and market share. The critical test going forward will be whether this strategic investment and global expansion can ultimately be translated into sustainable long-term profitability.